Okay, let's unpack this. Have you ever wondered what wisdom you could, pull from places you might not expect, like, say, detailed letters from a fund manager? Today, we're diving deep into the world of long-term investing. We're looking specifically through the lens of a prominent global equity fund manager's communications. What they tell their investors. We're going to peek behind the curtain a bit, see how this high-quality long-term fund thinks about the market, what they bought, what they sold, and really, the why behind it all. Our sources. Well, we've got two key documents. There's a letter from July 2023 covering the first half of the year, and another from January 2024, which sums up the full year. And our mission, really, is to pull out the most important nuggets of knowledge. Understand how a fund like this thinks, how it performs, how it navigates all the market noise, and maybe find some surprising facts, some aha moments for you along the way.
Yeah, what's so fascinating, I think, is how these letters give you such a direct, unfiltered look into their actual decision making. The principles guiding the investments. It's not just a dry report, it's a proper case study, almost like you're getting a feed directly from the mind of an experienced investor. It's quite valuable.
Precisely. So let's kick things off by looking at how they navigated, well, the somewhat choppy waters of 2023. In that first half, the fund was up a solid 8.5%. Okay, that was just marginally less than the MSCI World Index, which is 8.9%. But, while 1 year is interesting, this is where the long-term picture gets really compelling. Since they started back in November 2010, the fund's cumulative return is, wait for it, 549.7%.
Wow.
Yeah, compared to the MSCI World Index at 316.7%. So annualized, that works out to 15.6% for the fund versus 11.3% for the index.
Okay, that kind of long-term outperformance, it really begs the question, doesn't it? What accounts for that, especially when you see moments like 2023 where they actually underperformed a bit in the short term? And one metric that sheds some light here is the Sortino ratio. For the fund, it's 0.83. For the index, it's 0.51.
Right, the Sortino ratio. Maybe quickly explain that one.
Sure. So the Sortino is crucial because, unlike some other volatility measures, it focuses only on the downside risk, the bad kind of volatility, the stuff that really eats away at your capital and your confidence. So a higher Sortino, like the fund has, means they're getting those returns with significantly fewer of those gut-wrenching drops. And that's absolutely vital for long-term compounding. Really important.
That is such an important distinction. It's not just about the big flashy gains. It's about the resilience, how they get there, consistency. Okay, so now let's zoom in a bit on the individual players, the stocks themselves. The letters give us the top 5 positive contributors and also the top 5 detractors for the full year 2023. It's a good peek into their wins and challenges. So on the positive side, Meta Platforms was a real standout, made its third appearance as a top contributor.
Yeah, and remember just last year, some people were asking if it was a value trap.
Exactly. And then the stock was up 70% in 2023. It's a real testament to their conviction, holding through all that market skepticism. It really shows how sometimes the actual business performance is, much steadier than all the noise around the stock price.
That conviction is so key, isn't it? It's easy to get spooked and sell when the headlines are negative. But seeing Meta turn around like that, it just highlights how focusing on the underlying business, not the market mood, can uncover real value.
Absolutely.
Yeah.
Then there's Microsoft. It's consistently strong, right? Appeared for the 8th time as a top contributor. They bought it around $25 back in 2011, and it was up at $376 by the end of 2023. I mean, that's a true long-term compounder in action.
Mm-hmm. And what about Novo Nordisk? That's a fascinating story, too. It shot to fame because of Wegovy, the weight loss drug everyone's talking about now. But the fund had actually owned it for 7 years before all that hype.
Really?
7 years?
Yeah. They're initially drawn in by its unique drug discovery approach and the fact that the Novo Nordisk Foundation has a controlling stake.
Yeah.
That basically guarantees a very long-term view, almost like a philanthropic mission.
Yeah.
Their stated aim is actually to eradicate the ailment diabetes that generates most of their revenue. It's kind of incredible.
Wow.
So yeah, it's the perfect example of how they spot long-term quality way before it hits the mainstream radar. That's real patient capital at work.
Mm-hmm.
And then rounding out the top 5 contributors were L'Oreal and IDEXX Laboratories, both showing, impressive execution, reliable growth, good, solid companies. All right. But, okay, not every stock goes up forever. Let's pivot to the detractors for 2023. Estee Lauder was the interesting one here. It was the only detractor from the first half of the year that really seemed to worry the fund. The letters mention severe weakness in its supply chain and also mishandling of the demand-supply situation in China after the COVID reopening.
Right.
And ultimately, they sold their stake, which is a pretty stark contrast to how L'Oreal performed in China, actually.
This is such a crucial point for any investor listening. Not all stocks that go down are the same, right? Some, like maybe Waters and Mettler Toledo, they were hit by labs spending less after the pandemic splurge.
Yeah, the fund wasn't bothered by those. They said they might even buy more.
Exactly. Those can be genuine opportunities to buy more of a good business when it's temporarily cheaper. But others, like Estee Lauder in this case, seem to reveal deeper, maybe fundamental flaws in how the company operates. And that leads to an exit. It's all about figuring out which is which and then acting decisively.
That discernment, it feels like it's right at the heart of their whole strategy,
Yeah.
doesn't it? That simple mantra, buy good, don't overpay, do nothing. Hmm. Let's unpack that, starting with buy good companies. How do they actually define good? Is it just a feeling or is it quantifiable?
Well, they actually share this really compelling table. It compares their portfolio companies' metrics on what they call a look-through basis against the S&P 500 and the FTSE 100. So take return on capital employed, ROCE. That basically tells you how well a company turns its capital into profit.
Right. Efficiency.
Right. The fund's portfolio is at a stellar 32%. Compare that to the S&P 500 at 18% and the FTSE 100 at 17%. Huge difference. And gross margin, the profit from each sale before overheads.
Yeah.
63% for the fund's portfolio versus 45% for the S&P 500 and 41% for the FTSE 100. And, these aren't just abstract numbers. If you connect this to the bigger picture, it really shows that superior fundamentals lead to better long-term results, especially when you hit periods of inflation, like we've seen. Having high returns on capital and strong gross margins gives these companies a real buffer. They have pricing power, operational efficiency. They can handle shocks that would just cripple weaker businesses.
Absolutely crucial point. Okay, then, operating margin, how much profit from actual operations? 29% for the fund's portfolio, way ahead of the S&P 500's 16% and the FTSE 100's 15%. Cash conversion, turning profit into actual cash in the bank, was 91%. They noted this was recovering, still a bit below their usual 100%, but expected to improve in 2024.
Still pretty high, though.
Very high. And finally, interest cover. Can they pay the interest on their debt? A very healthy 20 times cover for their portfolio companies. Compare that to 11x for the S&P 500 and 10x for the FTSE 100. Much safer balance sheets. So yeah, the numbers are consistently significantly better for their companies. Superior quality, right? And get this, the average founding year for their portfolio companies is 1916.
Wow, collectively over a century old.
Exactly. They also mentioned 14% weighted average free cash flow growth in 2023. Just solid performance.
That longevity, it's such a powerful sign of durable competitive advantages, isn't it? These aren't just flashes in the pan. They're businesses that have proven they can last through thick and thin, multiple economic cycles, and that 14% free cash flow growth, plus the high cash conversion, it shows that fundamental strength is translating directly into real financial power.
Okay, so that's the buy good companies part. The next bit is don't overpay. How do they approach valuation? Well, at the end of 2023, their portfolio's weighted average free cash flow yield was 3.0%. Now, the S&P 500's median was actually higher, at 3.7%.
Right, and that often makes people ask, well, why is the fund's yield lower? Doesn't that mean it's more expensive, a higher valuation? And the answer is, well, yes, probably. It's not really surprising that fundamentally better companies are just more desirable. Investors value them more highly. You often have to pay a bit of a premium for quality.
Makes sense.
But the fund also expects that gap to narrow a bit as their company's cash conversion improves further. That makes the underlying profitability even more visible and effectively boosts their cash yield.
Got it. And then the final leg of the strategy, maybe the most counterintuitive one, do nothing. What's that about? It's really about minimizing portfolio turnover, keeping trading low. In 2023, their turnover was 11.1%, which they actually called a little higher than usual for them.
Still pretty low by industry standards, though.
Oh, definitely. And here's an amazing detail. Their voluntary dealing costs, the cost of actually buying and selling, were just 0.008% of the fund's average value. Tiny.
And that focus on doing nothing, it's not laziness, is it? It's a very active strategy to keep costs down. Costs are something investors often overlook. The fund calculates this thing called a total cost of investment, or TCI. It was 1.05%. That includes those dealing costs. You compare that to the standard ongoing charges figure, the OCF, which was 1.04%.
So the TCI is the real all-in cost.
Exactly. It's subtle but critical for you as an investor. The OCF is what's usually advertised, but the TCI tells the full story, including those trading fees. It just highlights how even tiny transaction costs add up and chip away at your returns over time, so their discipline in minimizing them is really impressive. Every bit saved compounds.
That attention to detail really does stand out. Now, they did have some notable exits in 2023, despite the low turnover. Amazon and Adobe were both sold. The concern was potential capital misallocation, basically wasting money on ventures outside their core strengths.
Right, the Amazon grocery thing?
Yeah, specifically for Amazon, they saw the CEO wanting to expand into grocery retail as going against his own stated investment principles. They thought it would destroy value, moving from a high-return core business into a low-return sector like groceries. And Estée Lauder, as we mentioned, was also sold due to those operational issues. On the flip side, they added Procter & Gamble, Marriott, and Fortinet. And they made a point of saying that 10 of their companies have been held for over 10 years, 5 of them right since the fund started in 2010.
It just speaks volumes about their commitment, doesn't it? They're not traders. They're genuine long-term partners with these businesses. They only sell if something fundamentally changes or management makes a decision that really undermines why they invested in the first place.
So given this very clear, very disciplined philosophy, you might wonder, how does a fund like this handle all the noise? The swirling macroeconomic stuff, the geopolitical storms. Well, their stance is pretty clear. They state outright they do not invest based on predicting macroeconomics or geopolitics. Things like interest rates, recessions, Ukraine, China, Taiwan, that's not their game.
Not trying to be fortune tellers.
Exactly. Their focus remains absolutely fixed on their strategy: find great companies, don't overpay, hold on.
Yeah.
But they do address some of the big market debates, like the renewed appeal of bonds, especially with interest rates having gone up. Let me give an example. If you put $100 in a long U.S. government bond fund back in October 2023, the expected yield over 10 years was $47.50. Compare that to investing in June 2020, when the expected yield was just $7. Big difference.
Huge difference in yield, yeah.
But here's the kicker. The actual value of that bond fund, the net asset value, fell by 48% between June 2020 and October 2023.
Ouch. Yeah, that's the capital risk side of bonds that people sometimes forget when yields look good. And it leads to that question many investors are grappling with now. If bonds offer decent yields again, why bother with the risks of equities?
Right.
But if you step back and look at the really long term, say 1928 to 2023, the S&P 500 compounded at 9.8% a year, with dividends reinvested. 10-year U.S. Treasury bonds, only 4.6%. And the critical difference, the thing people often miss about equities, is the reinvestment of retained profits by the companies themselves. That's the engine of long-term compounding that just doesn't exist in other asset classes like bonds. Bonds don't grow themselves.
That's such a key insight. So the message for the everyday investor is pretty clear then. If you want that long-term equity growth, you need, as they put it, an iron constitution to ignore the periodic shenanigans of the stock market.
Ah, shenanigans.
I like that. Yeah. And maybe that brings us nicely to the wisdom of the late, great Charlie Munger. Before we get to him, let's quickly touch on 2 really noteworthy events from 2023 that the letters mention. First, the undeniable rise of artificial intelligence, AI. AI was obviously a massive driver of gains for those magnificent 7 stocks last year. You know, Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla.
Dominated the headlines.
Totally. Those 7 alone accounted for something like 68% of the NASDAQ Composite's 43% gain. NVIDIA by itself contributed 11%.
It's incredible concentration, but what's insightful from the letters is the reminder that AI isn't actually new. IBM had Watson back in 2011, Google bought DeepMind in 2014.
Right, it's been around.
Yeah, and yet the market seems to have decided very early on who the winners are: NVIDIA, Microsoft primarily. Which makes you ask, does history actually suggest we can reliably pick the ultimate winner right at the start of a huge tech shift?
Good question.
Think about it. Early leaders. Intel in microchips, maybe. AOL in internet service. Nokia in mobile phones. Yahoo in search. BlackBerry. MySpace. Where are they now as dominant forces?
That's a really sobering historical perspective, isn't it? Puts the current AI hype into context. So maybe there won't be one single winner. Or maybe, as the fund suggests, everyone adopts it and becomes table stakes, leading to a situation where, quote, no one has any advantage.
Like that football stadium analogy they use.
Exactly. Everyone stands up to get a better view, but then nobody actually has a better view, just sore legs.
Yeah.
So yeah, the fund remains pretty skeptical about trying to predict the ultimate AI winners. Okay, the second notable event they mention is, sadly, the passing of Charlie Munger, Warren Buffett's longtime partner at Berkshire Hathaway. He passed away aged 99 in November 2023. And the fund highlights a Munger quote that just feels perfect for the current state of the world. If you're not a little confused about what's going on, you don't understand it.
That Munger quote, it fits so perfectly with the fund's whole philosophy of ignoring macro predictions, doesn't it?
It really does.
If the world is fundamentally confusing, then trying to forecast interest rates or geopolitical events perfectly is, well, maybe a fool's errand. So instead, they focus intensely on what they can understand and analyze, finding and holding great businesses. They essentially embrace the macro confusion by focusing diligently on the micro. It's a powerful lesson in, selective attention, knowing what not to focus on.
Brilliantly put. So let's try and wrap this up. We've journeyed through the performance of this specific global equity fund. We've uncovered the core principles of its long-term investment approach: buy good, don't overpay, do nothing. We've also considered their perspective on big market forces like interest rates, the whole bonds versus equities debate, and the massive wave of AI. Hopefully, you've gained a deeper sense of how an expert, disciplined investor tackles the market, focusing on fundamentals, maintaining discipline, and having a healthy dose of skepticism about hype and prediction. So what does this all mean for you, listening right now? Well, if Charlie Munger was right, and not being confused means you don't really understand the complexities, maybe the question is, how much confusion are you willing to embrace to truly grasp what's happening with your own financial future, rather than just reaching for overly simple answers? Something to think about.